Hi everybody, we're back with Bill Poulos, and Bill, we've been talking lately about the 5 key mistakes that traders are making, and today we wanted to talk to you about that number 1 mistake. They trade when they shouldn't, and I was hoping you could give us a little more of your insight on what exactly we mean by that.
Well, yeah, one of the key misconceptions traders have is that they can go into the markets day in and day out and have the same opportunity for profit. And nothing could be further from the truth. The markets ebb and flow. And on, some days and weeks, even there are not great opportunities. And other times, for months on end, there are great opportunities. So you have to know the difference, and a good trading method will tell you that. Now, here's some of the situations where you shouldn't trade. Let's say it's FOMC week, the week the Federal Reserve is meeting. That's not a good time to initiate new trades because of the volatility in the market that week as the Fed deliberates and announces interest rate policy. Another time not to trade, initiate a new trade, is the week of earnings announcement for a particular stock because, again, the volatility that drives just puts too much risk into the trade. Some situational events in any market and any stock that you might be considering trading would be a stock that gaps around. A gap meaning if it's in an up market between today's high and the next day's low, that's a gap up. If you see those kinds of moves, helter-skelter moves in the market for the stock you're considering, good to look elsewhere because this is too volatile, too unpredictable. Another one would be wide range days, unusually wide range days, where the stock was trading quietly. All of a sudden, it starts making these huge swings. Too much volatility. Stand aside. Another one would be when it's chopping around in a very tight range, going no place fast, especially after a dramatic drop. The stock will tend to go sideways for months. And there's no point in trying to swing trade a stock like that because there's limited opportunity. So that's just a few of the situations and times where you should not trade. And, as a trader, you have the great advantage of not having to trade all the time. You can pick your points. And that's half the key to success in trading.
And doesn't not trading sometimes save traders more money than they could actually make by being in the market?
Sure. Those are the times. The times that I've identified are the times where the risk-reward's out of kilter. What you want to do is enter into a high probability, low risk situation. And those incidents that I just tipped through are not that. That is not when you want to be doing that. You want to be getting into the markets when they're relatively quiet, meaning they're trading deliberately in reasonable trading ranges day to day, and the method you're following sets up telling you to be on the alert for a trigger to get into a position. When the market's in that quiet kind of mode, that's what you're looking for. That's when the risk is lower. That's when the potential opportunity is higher.
Great. Thanks a lot, Bill. We'll be back with question or mistake number 2
Okay.
just a little bit.
Okay.